So that was all I need to say about CGT. Nothing major change there, so all good. Now let's come to the interesting area, the one that you've been waiting for, superannuation. As you know, before Tuesday night, there was sort of a few leakages as well in terms of the changes. So I must say that, I'm okay with it. Could have been worse, could have been a lot worse. So let's have a look at the changes which were proposed. Firstly, I'm a bit disappointed with this one here. Deferral of the 50,000 sort of higher concessional cap deferred for another 2 years. So hopefully, not like many of the promises that hopefully will not be scrapped in a couple of years' time, but on basis on Tuesday night, it is being deferred. So the 50,000, so just quickly on the rule, 50,000 applying to someone aged 50 and over, and a balance of less than 500,000. Those are all still intact, but instead of applying from 1st of July this year, 2012, it's now been deferred for a couple of years. So in effect, if it's not scrapped by then, and if we're getting it, probably through indexation, it will be 55,000 instead of 50,000. So let's keep our fingers crossed that we will eventually get there. No promises, but hopefully we will get there intact with 55,000. We still have the same problem with that 500,000 balance. So that's yet to be defined. As you know, we've been yet to define for quite a long time now, and it's going to be yet to be defined again for the next couple of years, assuming that we get there and we have that. So what do we do in the meantime? Well, nothing much we can do in the meantime, unfortunately, but continue on with our existing strategy, right? Remember, for those of you who deal with me, I've always been saying, look, we should always super contribution split, especially in light or in anticipation, in expectation of the 50,000 1st of July, which we're not obviously getting this year, but in a couple of years' time, hopefully, is to continue with the splitting of contributions. And I've always maintained the case with, you and your husband, you and your spouse, you and your wife, clients where they're married, that we should always income split. And no different with super contributions too and super balance. If we could do it, super contribution definitely, then we should be splitting contributions to equalize and to keep the balance as equal as possible. So regardless of the 25,000 or 50,000, we should always split our contributions. And remember, we can do super split, and we can do the split based on the last financial year. So you could certainly do it now for last financial year, and don't forget 1st of July you could then do a split for this financial year, unless you're transferring from one fund to another, which then you could actually split in a year of transfer, right? So let's keep that strategy going, because we should be doing it anyway, regardless of if this change comes through or not. Now, having said that, then what's the next thing that we should be aware of? Well, if for those clients that we no longer get the 50,000, then we've got to get them down to 25. So that means it's 25,000 for everyone from 1st of July onwards, regardless of age or balance. So 25,000, we've got to get it down to 25,000 just to ensure that we avoid any excess concessional contributions problems. So especially true for those of your clients who sacrifice bonuses. So just make sure that if they have bonuses and in the past that they have hit sacrifice directly to super, that make sure that in all together is 25,000 and no more. And the last important consideration is your TTR strategy. So because of the fact that you may have planned for those of your clients age 50 and above to put in 50,000 as part of your TTR strategy and optimizing based on that higher level, then you need to consider what the impacts are now that we're 25,000. And don't forget too, we did have some of the tax changes as well. So in any case, as part of your annual review, then your TTR strategy should now take into consideration and in working out the optimum sacrifice amount on the basis that is on 25,000 and not 50,000. But most importantly, just to make sure that from 1st of July onwards, that you bring all your clients down back to 25,000, just to avoid any potential problem. And certainly if there are one-off bonuses that have been in normal circumstances been put into super, then just make sure that those bonuses, if it's going to go into super from 1st of July onwards, will be within that $25,000 limit. Don't forget SG is included in there as well too. Now, the only other one which obviously you've been reading a lot in the papers about is the reduction of the contributions concession for high income earners. All right, and basically what it's saying is that for high income earners, and which we define in, as you can see on the slide there, is that the contributions tax applying on them would be, as a result of reducing the concession for them, is to increase from 15% to 30% the contributions tax, pretty much like the surcharge, isn't it, back in those days. The only thing that you need to be looking at is really high income earners, what the definitions are. Do you have any of these high income earners anyway in your client portfolio? But basically high income earners are defined as ones with income, so it didn't really get into the definition of what income is. So at this point in time, without the legislation, is income greater than 300,000. But what we do know is that income is defined to include concessional contributions. So for example, if you have a client who earns $280,000 and had a $25,000 concessional contributions, for this purpose the income is $305,000 if I can add. 280 plus 25,000 is 305,000. So for this purpose then they will be termed high income earners, and then contribution tax would apply at a higher rate of 30% to these individuals. Now, a small point here, well, it's not a small point, but the way it operates is it only applies, 30%, it only applies to any contributions in excess of the threshold. So in my example, for instance, we have someone 280,000 taxable income, so I'm not even going to refer to taxable income because I don't really know what incomes really means. So if his income is 280,000, then we have a $25,000 of concessional contributions. For this purpose, it's over 300,000, 305 in my example. Then we've got to think about the 30% tax on contributions. Now, in this case, we have 25,000. The 20 is added to the 280, makes it 300. The 5,000 is in excess of 300. That means 5,000 of the concessional contributions will be taxed at 30%, but not the 20,000, which is included in the $300,000 limit there. So of the 25,000, 20 would be at 15%, 5,000 would be at the 30% tax rate. Talking about trying to make it complex, we could have just easily made that everything taxed at 30%. But just be aware that it's only on contributions tax and only for high income earners. So what do we need to do with your clients who are high income earners? So let's have a look at the strategic considerations and impacts. Obviously, we need to consider if your clients are high income earners, or they could be bordering becoming high income earners. We need to look at sort of managing the income, especially once we do know exactly what incomes means, but just for this purpose, just ordinary income for the time being. Then looks like for some of these individuals, then they may have tax effective structures involved, companies, trusts and what have you. So it might look like it's a return of these tax effective structures to try to contain the income and the concessional contributions to below that $300,000 mark. So it's something which you perhaps could consider, and it might be one which you need to work with their accountants as well too. I think another important consideration is the limited recourse borrowings. This is obviously stopping the contributions going in at a concessional tax rate. In a way, that may not be that important anyway, but it does again bring into the spotlight, I guess, the limited recourse borrowings, which does provide some concessions to be able to have the earnings, capital gains within